trading isn't about hype. It's about liquidity, structure, and momentum. And here's how I think about it. First things first, trade the majors. You're much better off just sticking with Bitcoin and Ethereum. These move very, very clean. They respect levels, they respect price action, and they don't wick like crazy. And if you can't trade these well, then you shouldn't even be like worrying about the other stuff. And then once you get proficient at Bitcoin and Ethereum, this is where you can perhaps start moving into strong trending coins like Solana, Avalanche, and major layer 1s and layer 2 coins. Once again, these are the narrative leaders. If Bitcoin is the market engine, these are the sports cars that move harder in trends because they all follow Bitcoin. And only then, once you are done, then you can start looking at narrative plays like the AI coins, infrastructure tokens, like coins that is heavily based on where attention flows. And you should only look at this stuff when there is momentum, when it's trending, when there is volume. Because momentum plus liquidity equal opportunity. Narrative without liquidity equal trap. And then last but not least, we got the speculative plays, like the meme coins, the micros, this is essentially like the penny stocks in the stock market. You don't really trade this all the time. You trade them during very specific moments. When volume explodes, when there is real liquidity, real demand. Because if you try to trade meme coins during slow period, like I said, you're just going to end up being the exit liquidity. So my point here is that you don't start by trading meme coins. You earn the right to trade riskier assets, not the other way around. So start in this particular order. Start with the majors, then go to the high liquidity leaders if you want, then the narrative leaders, and then, like I said, if you want to trade the speculative plays, put a very, very small portion of your capital into it, right? Maybe 10% or less than that. Now, before you continue, I need you to understand something. Investing builds wealth slowly. Trading accelerates wealth if you have discipline. And confusing the two is how people blow up accounts. This video is about trading, okay? It's not really about investing. It's definitely not about backholding meme coins and calling it long-term conviction. Buddy, chill. You're not Warren Buffett, okay? Cool? Gucci? Cool. Now, when you pick coins to trade, there are two layers of thinking. Fundamentals keep you safe, but momentum gets you paid. So let's start off with fundamentals. And don't get it twisted. I'm not saying we become long-term investors. But if you pick trash, you get trash outcome. Crypto rewards hype, but it also brutally punishes ignorance. So fundamentals allow you to filter out all the garbage, or like the shit coins first. So these are the list of questions you have to ask yourself to ensure that, this coin actually has sufficient liquidity and is actually worth trading. The first thing is there like a real use case? Is this solving a real problem? Or is it just a fancy website and a pipe dream? If there's no reason for the token to exist, skip it. Speculation without utility eventually dies, right? Without hype, without volatility, without attention, that coin is just gonna fade away. Next thing you want to ask yourself is there a strong team behind it? Now, once again, you don't need to worship founders, you don't need the next Vitalik Buterin, but you do need to check if they're legit. Have they shipped before? Do they disappear and run away with your hard-earned money in bear markets? Do they pump and dump, In crypto, founders who vanish equate to your money vanishes too. So a good example of like a strong team is look at the Sui coin that came out recently. Not recently, but like a few years ago. SUI, right? That coin is pretty much backed by Meta employees or ex-Meta employees, right? So you can see that there's a strong team behind it and it actually has like a real use case as well. Next is on-chain activity. Now, you always want to make sure that you follow wallet and users, the order flow, institutional flow of money, rather than marketing. If usage is increasing, liquidity flows behind it. And if nobody's using it, then you're just gambling, bro. Next is volume. Volume to me is like oxygen. Without it, you're stuck in a position begging someone to take your bags. High volume means you can get in and out without sleeping like a clown, right? High volume means high liquidity. It's the same thing with real estate. Real estate, low volume, low liquidity. It can take months to actually sell off the house. But with crypto, if there is sufficient volume, there's a lot of liquidity in the market, right? It's fairly liquid, then you can easily find a buyer to fulfill your sell order, right? So once again, high volume equal high liquidity means you can get in and out fast. Not just hype. This is probably like the most important question right here. If the only reason the coin is pumping is because of, I don't know, freaking TikTok or like stupid influencers, be careful. Because narrative alone can send coins flying, right? All the fanboys start buying the coin of that particular trading influencer. But when the hype dies down, which it inevitably will, it crashes twice as fast. So you always want to make sure that you are buying, or rather you are trading a coin that actually fulfill all of these criteria right here. The more criteria you actually checked off from like this list right here, the stronger the coin is, and the more likely it's not going to go to shit, and the more likely you can trade it safely. So the bottom line here is fundamentals do not make you rich, but they sure as hell stop you from blowing up. And that's all you need. Next, we got technicals. If fundamentals keep you safe, then technicals decide if you enter, when you strike, when you buy, when you sell. So once a coin passes a fundamentals test, right, you pretty much answer all of these questions right here. Now we can trade like killers. Then now we can ask ourselves the next list of questions about technicals. Number one, is it trending? Always remember, trend is king. If it's moving strong and clean, ride it. If it's chopping, going sideways, there's not much opportunity in the market, there is no clear trend direction, leave it. Because I've learned it the hard way, but choppy markets kill more accounts than like bad entries do, right? So it's not worth it. And this is especially true for crypto as well. Like when crypto trends, it trends really, really fast and long. So you might as well ride the momentum. Next is there clear liquidity? Once again, we are not here to trade stupid coins which doesn't exist. We don't trade ghosts. If there is not enough liquidity in the market, your entries and exits will get wrecked. All right, like you won't find sufficient sell orders to fulfill your buy orders. You will get in and out too late, or even get in at bad prices because there is insufficient liquidity, right? And then you have to suffer the cost of like bad spread and pay more commission and fees. That is really quite unnecessary. Because remember, smart traders, they serve wave, not powders. Next is volatility tradable, not random? Some coins, they move quite clean. And some other coins move like freaking crackheads. We want structured price movement. We want assets which follow price action, not chaos, not randomness. So volatility to a certain extent is good, as long as it's controlled and it's readable. And then next, you want to ask yourself, is Bitcoin supportive? I want you to view the entire crypto universe or the entire ecosystem as like the solar system. Bitcoin is essentially the sun. Altcoins are essentially planets, which also means that if Bitcoin dumps, the whole solar system crashes. Everything else is following Bitcoin. So never fight the king. Always check the Bitcoin first. And last but not least, ask yourself, is the narrative hot right now? Because crypto moves in story circuits. Unlike traditional stocks, right, where there is a certain intrinsic value attached to a company, crypto moves based on sentiment, based on how the market feels about that particular coin itself. If there's hype, there's a lot of attention going into it, like I said, that's where the money is going to flow to it, including institutional money. So example, like right now AI is trending. Then if that's the case, then you can expect a large amount of institutional volume or even retail volume going into the AI tokens. And then maybe in the future, we got metaverse tokens popping off because of the fact that, everybody start adopting metaverse, right? So whatever is trending, whatever have like this awesome story behind it, that is where money is usually going to flow into. So if you trade the right crypto at the wrong time, you lose. Point blank period. So in Wall Street, we have this adage called, if you are early, it's just the same as being wrong. Like being early is just the same as being wrong, right? So you always want to make sure that you are getting in at the right time, at the right place, at the right price. And if you catch the right narrative early, then my friend, you're going to print. So my point here is that we don't predict narrative. We recognize them early and we position ourselves fast, ideally before the institutional flow of money. Basically, fundamentals keep you from being the exit liquidity, while technicals, narrative, volume give you the rocket fuel that price needs to actually 10x or 100x. So you always want to make sure that you trade from a position of strength rather than blind dreams. Now,